both the structure and regulation of banking in the United Kingdom need reform. Banks increased both the size and leverage of their balance sheets to levels that threaten stability of the system as a whole. They remain extraordinarily dependent on the public sector for support. That was necessary in the immediate crisis, but is not sustainable in the medium term. In creating the crisis, imbalances in the world economy led to an unusually low real interest rate and large net capital flows from the emerging market economies to the developed world. That provided the fuel which an inadequately designed regulatory system ignited. If our response focuses only on the symptoms rather than the underlying causes of the crisis, then we shall bequeath to future generations a serious risk of another crisis, even worse than the one we have experienced. Why were banks willing to take risks that proved so damaging, both to themselves and the rest of the economy? One of the key reasons, mentioned by market participants in conversations before the crisis, is that the incentives to manage risk and to increase leverage were distorted by the implicit support or guarantee provided by government to creditors of banks that were seen as too important to fail. Banks and their creditors knew that if they were sufficiently important to the economy or the rest of the financial system, and things went wrong, the government would always stand behind them. And they were right. The sheer scale of support to the banking sector is breathtaking. To paraphrase a great wartime leader, never in the field of financial endeavor has so much money been owed by so few to so many. And one might add, with little real reform. The massive support extended to the banking sector around the world, while necessary to avert economic disaster, has created possibly the biggest moral hazard in history.